Good afternoon, everyone. Welcome to today's market briefing webinar. I'm Henrik Zeberg. I'm the macroeconomist at Swissblock, and I'm joined today again by Willy Woo and Yann Allemann, who will be coming in, caught up in traffic. And before we start out here, I just want to put up our normal disclaimer. Please note that this webinar does not constitute financial advice. Everything discussed reflects only our personal opinions on the topic at hand. Always conduct your own research and consult a professional before making any financial decisions. Participation is voluntary, and the information provided is intended for educational and discussion purposes only. Today's session will last approximately 45 minutes, 30 minutes of discussion, followed by 15 minutes of Q&A. If you'd like to ask questions, please use the space at the top of your screen to send it directly to us. And please note that this talk will be recorded and sent to you directly to your inbox. All right. And with no further ado here, I will then start off, Willy, as we discussed. So again, like now, macro is not something that moves really quick. We know that. So even though, we would like to see things developing over the course of a week, it doesn't happen that fast. Obviously, we had the FOMC yesterday. We had Powell coming out, not being too worried about the slowdown in the economy, which is something that is quite, well, I don't understand it. I mean, I am really surprised to see that they seem to be blundering again here when it comes to the whole economic situation. And in order to show a little of that, I want to share just a few charts here that may show some of this. First, I want to show, I just need to share it here. Hang on for 1 second, guys. We'll see here again with our business cycle model that I showed the last time as well. We know how when we have, and I just want to move the picture here of us. Every time we get a crossover, we will get a recession at some point. This is what the leading indicators gives us. We have had a crossover here in November 24, and we know that should lead to a crossover of the coincident indicators, which are the employment, manufacturing level, GDP growth, and so on and so forth. And then it will lead to yields decline. And this is also what there is, everybody's talking about, why are yields so high? Well, we know that when the economy is rolling into a recession, then the yields and inflation declines after that. That's why they are lagging indicators. And that's also why they're not very good for running, so to speak, the economy as Powell is doing. So he's sitting there and waiting for the things that actually will happen after you hit a recession to happen before. So he keeps being so hawkish, even though he should be observing the leading indicators. And the leading indicators are very clear on what's happening right now in the economy. And if I just shift here to, let me see if I can just find the chart really quick here. Oops, I have so many things open. Yeah, there we go. One of the things we can be looking at is the housing market. The housing market is actually a leading indicator on the indicator on the economy. Why? Because what happens in the economy is that when the party gets going, when the business cycle is moving up, then you know that the Fed will go in and try to take the vodka bottle out or the whiskey out from the party. What they do is that they hike rates, and we also see that yields are moving up. This is not the Fed doing that. That is market demand. That is supply and demand in the financial market. And when that happens, at some point, the yields and the rate starts to become so high that it actually hits the housing market. So everything we do with housing requires that we will borrow money to a certain degree. The very few people will actually be able to buy a house without having to go to borrow some money. So when that yield moves up, that's also when the housing market starts to take a beating at some point. And that we can see here as well. And this is a broader measure of it. The NAHB is a broader measure. You can see what it is down here. When that tops out, that's actually when the clock starts for the business cycle to roll over. And the harder we see the decline in the housing market, the stronger the rise it is here in the unemployment rate. It's an inverted curve. So when we see that and it starts to decline as we saw into the financial crisis, we should be worried because it's actually telling us that the economy is slowing down rapidly. See, now we fast forward here to what we see right now. And we have seen that this has actually declined quite a lot, the NAHB index. We have then seen it going sideways, which is a consolidation. We haven't seen the effect to this degree yet. My hypothesis is, because of all the stimulus that came out after Corona, that people have had more buffers in the savings, which means that they've been able to keep spending for a little longer. And we all do that. We will try to make ends meet. And now we know that they are struggling. If we look to the credit card delinquencies, and we look at car loans delinquencies and so on, they are moving up. Why? Because we know that the consumer is struggling with their, and I can't see my own chart here, which is a little annoying. Let's see, can I move this away? I can. So what we see is that when the interest payments go up, we see that unemployment for sometimes after recession here will then decline. But as they go up, all of a sudden, we'll start to see unemployment moving up. This is into the corona, but here we'll see it more better. So the housing market is affected by interest payments because the higher they are, the harder it is for the consumer. And at some point, they will stop or spend less, which then will be the slowdown in the economy, and that will roll over to the economy into and become unemployment. That is what we see every time, and that is also what we see this time around. And people talking about a soft landing at a point where the personal interest payments are so high as they are right now, and the rates are so high, simply do not pay attention. And I think Powell is not paying attention right now. So I think there is something very, very wrong in the economy right now. And we can just look at the charts. Here we got the SPX, so the S&P, the stock market versus the US Coincident Economic Activity Index. And we see how there is a big gap there. The financial markets and the real economy has simply diverged. And this is what happens in a bubble. And also, if we look at one of the things that is a very important factor in an economy, that is transportation. We do not see that transportation index is now following the stock market higher. So at this point, things are not looking great. And I do know that, of course, at a point like this, liquidity is important because that was the Fed and central banks around the world is trying to do. They try to send liquidity into the market to try to save things. But for as long as the rates stay high, it will not help the consumer too much. And I think we're seeing now a train wreck here in slow motion. And we can see how the ECB is way ahead of the Fed, and the Fed seems to be reluctant on cutting rates, and that's again what we saw yesterday. So even though they were that, we can still see that liquidity is coming in, and that is something that is good for Bitcoin in a historic perspective. And this is where Willy Woo knows much more than I do, and I will leave it up to you, Willy, to talk a little about that.
Okay, thank you, Henrik. Just in simple terms, as Bitcoiners, we all know that liquidity is actually another word for government money printing in fiat, expanding the money supply. And so obviously Bitcoin being a very limited supply, capped supply of 21 million, it's going to perform very well under paper debasement. So actually, if you were listening into last week with this briefing, not a lot has changed, slight developments, but mainly the structure's pretty much like last week. This is the yellow line here is the risk model that we have. The risk model is really sensing liquidity across the cycle, mainly on the buy side. Basically, how much capital is coming in to support the price of Bitcoin relative to a sort of a 4-year cycle. And so when the risk goes up, that means liquidity relative to the price expansion is dropping off. And so when that happens, kind of the gusto of pushing price up starts to drop away. And you'll see this as a multi-month warning of a top coming. So in 2017, you could see that it was actually fired in the $2,000 range, even though the top was 20,000. And the risk would drop and then we'd fire up again, but it would chop around and give you a lead warning signal. This was a 6-month warning signal. In the last cycle of 2021, it fired in January and the top was November. So that was 10 to 11 months there before it fell down. So even though the risk is climbing, the liquidity is waning relative to the price rise, it's not to say we're at the top. Obviously with global macro, we're going into recession according to the indicators, but the ship's not sinking right now. So Most likely, we are going to move upwards if you're a macro cycle investor. It's not really a double top as other people are seeing it, just from technical patterns. Fundamentally, it seems a little bit too soon. Um, and I will just move over to a more fundamental view of that liquidity. In this purple line, this is actually measuring the entire system of Bitcoin and how much capital it's absorbing in, right? And so actually here you can see that's 1 billion. We're currently absorbing $1.2 billion per day coming into the Bitcoin network. And it's not the actual rate of capital coming in, but it's actually the change of capital. Is that rate climbing or is it dropping? If it's climbing, then it's a bullish environment. If it's dropping, it's a bearish environment. And so we're currently in this sort of rollover, early signs of rollover, but we don't know if that's for real because you can see it can sort of sit around sideways and that changes every day. But as of the last month, it's been really flat. And because it's in a flat environment, we don't have this kind of tailwind environment. If it's bullish, there's a lot of spot buying and it's an increasing rate, and it's like any dip tends to be bought up. And in an environment where it's bearish, there's headwinds on bullish action. Right now, it's been neutral, and it's actually been like that for a month. And in that environment, and in an environment where we have a lot of speculation. So if I go to this chart here, and look at this purple here, this is actually the speculation in the system, and we're coming off this zone where there's been a whole lot of speculation going into the top, a lot of late longs coming in, and we've been detoxing out of this sort of paper bet environment. And so we've been in this space where like it's just like tactical trader wars between positions. And so here in the heat map, the hot spots are where people will get liquidated, and you'll see it's kind of a random walk without any kind of tailwinds from fundamental capital flows coming to the network. And a lot of that has been purged, so it's a lot healthier than it was even last week. Last week was up here. Now we're into the zone where it's starting to look interesting. So you really want to see the speculation down into the negative, like 1, 2, 3, 4 standard deviations from the norm. And so we're heading into that space. There's a bit of time to move. I'm not seeing this curve like start to initiate and get out of its purge. And once that happens, it's generally a good environment where we can rebuild a bullish base. So that's where we are. I would probably also turn on the shorter term indicator here. This one's picking up on the speculative capital, and it tends to be leading. And so again, this is kind of reinforcing the idea likely this is going to roll over. We don't know for sure, but the leading indicator says it's coming down. And maybe that stops very quickly and comes back up, and this will chop sideways, or maybe it continues to come down and we get kind of a bearish phase. If we do, then we will have more headwinds for bullish actions, and I would expect further sort of cool down from very, very almost overheated run coming up to the top. It came up here from very bearish to very bullish, and in terms of like mean reversion oscillations, it was very overbought here, and this is a very nice cool down. And if we get into a price range in the mid 90s or even low 90s, that's a great place to launch from, because you're now oversold in a very healthy place to spring up and break all-time highs. And so in a timing signature, just looking at the way these charts are shaping up, it's looking like we might have a good bullish launch pad into July. And just on the short time frames, this paints it as well. This is VWAP using on-chain volume rather than exchange volume. And again, as we get into these lower bands, if we see this turnaround, it's usually a good place to launch from oversold. And again, a different view is this is SOPR. So it's really a measure of how much profit has been transmitted between investors. And when you see SOPR go up and up and up, that means there's a lot of profit in the books being transmitted. And as it rolls over, that's pretty much a sign that investors are selling and selling and selling, even with less profit. And that's the sign of profit taking. And generally, we want the profit being transmitted in the books between investors to be near zero so that there's no more selling to be had by the guys in profit. And we're not there yet. Again, lately, the last week has been very flat. The profit taking has stopped. Sometimes that, if it's a very bullish environment, it can go back up, but I've just covered that it's not in a bullish environment with capital flows. Like if this was running up, then certainly I'd be more expecting SOPR to increase profit and the whole price to run up. But right now, I'm looking also into July for this to cool down closer to zero, and that would be another fundamental piece in the puzzle to have a really good launch pad to break all-time highs. So yeah, that's how I see it. And I will hand over to Yann now with the Hawkeye models and framework, which really is looking at flows and liquidity and microstructural volatility between the entire ecosystem of crypto. We can pick up a lot of market signaling around where Bitcoin's going, where are the flows going into altcoins, are they going back into Bitcoin? And between that, you can actually get pricing structure of where Bitcoin will go. So over to you, Yann.
Thank you, Will. And yeah, for those of you that don't know me, I am a co-founder at Swissblock and Glassnode. So I've spent the better part of the last 12 years together with Willy, and a bunch of other very sophisticated researchers, and really trying to figure out the question of what Bitcoin is. And we've over the years come to the conclusion that it is all about liquidity. Bitcoin is a liquidity sensitive asset. It's the canary in the coal mine for liquidity, as we call it, within our own circles. And that's basically what I wanted to give a little bit more color on. So as I launched Hawkeye, I wanted to basically just quickly touch upon a couple of things that Willy has mentioned. We are in a interesting situation now because you have a lot of different dynamics that are coming together. You have on one side external pressures from the uncertainty that is coming through with tariffs now again, right, leading into the 9th of July, which is the deadline, at least the current deadline that the Trump administration has actually given. We also have on the other side the waning part of the first reignition of liquidity into the space that started on April 7th. For those of you that were not there in the last webinar that we did last week, I would highly suggest that you listen to that because we touched upon basically the global bottom that we saw on the 7th, 8th, 9th, and how the framework was also able to pick that up, right, from a pure liquidity and cohort analysis type of perspective. And basically to touch upon what Will said as well on the liquidity side, just to quickly open. So we basically have a situation looking back at something that is looking at a similar thing to SOPR. So we're looking at basically the profit loss of the system. And what we basically do here with the middle time series that we call the risk off signal. What we basically do is that we track, and we've identified over the years the types of wallets that really drive liquidity, right? So basically, on a simplistic sense, this is what people refer to as whales. But the problem is that we always have to ask ourselves, what is a whale? Who's actually driving the price behavior? And when do those behaviors become very pronounced in the system? And what we've basically done is that we've taken all of those different cohorts and we've aggregated them together into a signal that we call the risk-off signal. And what that basically does is that it looks at all the different price points that these major wallets have been accumulating at, that basically are responsible for really driving liquidity in between exchanges and from large entities towards exchanges. So basically flows from and towards exchanges. And we look at what their cost basis is like. So think of it like a look or a looking glass into knowing when, let's say, to give an example, when Bill Gates is getting close to the cost of acquisition of Microsoft. And you know that when Microsoft starts getting close to that point, he starts getting very nervous because he's going to start actually being at an actual loss, right? Instead of actually being in profit. And you can do the same thing with on-chain. And what is interesting about that is that that signal has actually been reducing, and the peak of that signal was actually exactly at that April 7th to 10th that we discussed in the last webinar. And it has actually been dropping off ever since. And this has been very consistent, historically speaking, with major bull runs. So the last one was basically on the 18th of September. So that was when officially, from our vantage point, or let's say the statistical vantage point, probably the 27th of September of last year, that's when the real bull market started, that ended in, let's say, early to mid December of last year. The same thing can be said to basically the beginning of 2024, when we basically had the massive run from January 1st all the way to April 14th, which was the major correction that we saw, particularly in alts, right? And that is important to understand because the collapses and the rotations out of investments, right? If it's Bitcoin, Ethereum, or altcoins, they usually start happening when you start really seeing flows going into the risk part of the curve, right? So think of it like, Bitcoin being on the far left, and then altcoins and like small caps and nano caps being on the far right. So the faster you go and the further you go along that risk curve, it's like stretching an elastic band. At some point, the amount of liquidity coming in and the amount of liquidity gyrating between large caps, mid caps, and small caps becomes unsustainable because you start getting a lot more profit taking. It's the buyers are not able to absorb the selling, and then you unravel. It becomes a massively quick unraveling. And the risk signal is able to basically identify the beginnings of that unraveling. So as of now, to Will's point, we are starting to get to a point, as you can see in the bottom part here of our systematic momentum following and volatility following strategies. We are getting to a point where, we need to start looking at where capital is rotating, and really understanding of when we're getting close to those liquidation levels, liquidation clusters, when you can have those spikes down. But we're not worried yet because the risk off signal still is zero, which basically tells us that from a macro structure, macro perspective, we're still in a dominantly positive structure. So it's still very bullish on a multi-month type of timeline. When this signal would start moving out, like it did over here, it did also in the middle part of last year. That's when we really start going structurally risk off, right? When we actually start even going into actual short positions. So this is a very good signal to know when the bias should be going from exposure to cash. So that's really important. On the flip side as well, what's super interesting and that we were actually seeing, if you were part of the last webinar, we touched upon this quite a bit, is that we're starting to enter a Goldilocks phase as well. So Goldilocks here meaning specifically the right balance short term, so basically between now and the next 3 to 4 weeks, so leading up into the July timeline that Willy was mentioning before, of potential strong upside. Now, that doesn't mean that it's going to happen today or tomorrow, but it means that things are starting to position themselves in a way where the probability of a large move up is very likely. And the reason for this is that we're starting to get a combination of basically becoming less exposed or less and influenced by external factors like war, like Trump tweeting about a tariff. We're starting to see an uptick in liquidity and on-chain activity as well, that you can see here. So the further up on the y-axis you go, the more dominant liquidity mechanisms idiosyncratically are in the space. And that usually leads to very strong environments. So if you look at the up cycles here that we've had in the past, like this one being one example, second end of 2024, we've always had them in the top left quadrant. They tend to not happen when you're in this kind of more consolidation phase that you saw here. The middle area, which is where we've actually been over the last 2 to 3 weeks, is to Will's to Willy's example, a consolidation phase and a distribution phase. So that's where market makers are fully in control, right? Because they're able to basically take out the longs and the shorts as the flow and dynamics are not dominant towards one or the other side, not positive or negative. They kind of range in between things. So that is very, very important to keep an eye out for as well. Another interesting thing, which is something that we track very closely together with the risk off signal as well, and that becomes very important in inflection points, is what we call the structural shift signal. So what that basically does is that it takes together around 40 different metrics that we've been tracking over the years, and it helps us identify when you have big inflection points. So as you can see here, over the last years, these inflection points have coincided with big drops or big tops or bottoms every single time. And the reason for this is that we're basically tracking when specific factors of long and short window volatility become dominant with each other, or basically constructive or destructive, to keep it simple. And whenever they're constructive, they tend to lead to big moves in price, because they tend to basically lead up to events where the volatility bands are basically constraining. Think of it like loading a spring. And then at some point, it is not able to basically encapsulate the energy, and it just lets go. And those tend to overlap with big shifts in the market. As you can see right now, that shift has not indicated that we've actually entered a different environment, meaning that we are still, in a structural sense, from a price perspective, still in the same environment that we were since the peak end of May. So we haven't shifted into a different environment, something that you would have basically seen here, right? So when we were at the bottom phase of this cycle here, we had a massive drop or a massive shift in the factors that led to the actual bottom, and then an actual shift in positive again when you actually had volatility, momentum, and liquidity coming into the system. So as long as that is the case, we do not expect to see a major change. But as you've seen in the past, these changes happen very quickly. So usually when you have this consolidation at this level, you expect something to come out of nowhere, right? It could be a piece of news that catalyzes. It could be a shift in liquidity paradigms, something that really ignites and kind of overwhelms the either buyer exhaustion or seller exhaustion, depending on where you are in the cycle. So this is something that we're going to be keeping a very close eye on, and something that we will be discussing at length also in our Vector series. On the fundamentals part, to Willy's point, the graph that he mentioned before, I think is probably the best graph for macro liquidity that I've seen in the space. I think it's so elegant and adds so many different pieces together, and to give you really an understanding of when speculation is dominant and when the investment, let's say more long-term duration, buying dynamics are really dominant. What I can add to that is only a subsection of what Willy discussed, which is really what we define as market liquidity on a more shorter time frame as well. And what we're seeing here is that we are actually looking at levels that we last saw back in February of this year, when we had the big sell-off, or basically right before the big sell-off in Bitcoin. So we also need to keep a close eye on those dynamics, because we don't want the liquidity to dry up to a level where there's really not a lot of interactions. What is different this time around than February is that there is a lot more homogeneity, meaning that there is the environment is not driven by a few big accounts. There's more distribution. There's more big players actively engaging in the system, but we would like this to start ticking up again, because we want liquidity to come in. Think of it like from this perspective, Bitcoin at the end is a dynamic system, right? It's a massively dynamic and complex system that is basically revolving around the sharing of resources, in this case, Bitcoin. The more those resources are being shared, the more they are being moved from one address and entity to the other, the more likely it is for that to have a positive effect in price, because you start creating mismatches in supply and demand dynamics, which usually lead to big price dislocations. When that drops off, it is equivalent to some extent as a velocity in money, or the velocity of money dropping off again as well, right? That usually means that it's not being used as much, which generally is a bad thing for the system, because the less you use the resources, the more valuable the resources are fundamentally. So this is something else that we're going to be tracking. What makes us less uncomfortable as what we saw back in February is that the actual network growth, so the amount of market participants that are in the space, has actually stayed very healthily high, which is very good. So we would start actually worrying when that starts dropping off, because a combination of less people in the system with less activity will very, very likely lead to lower prices and significantly lower prices. That is consistent historically with big sell-offs, so big global tops, and then confirmations in actual bearish structures. Let me see if there's another important thing. Yes, another thing based on our last discussions is that we are now back in a Bitcoin dominant environment. This has actually been the case since the 16th of June, sorry. So since 16th of June, since about 3 days, we're again in a Bitcoin dominant environment. So we would like to see that switching back into Ethereum. So ever since we've had the big move in price, we've had this flipping back and forth between Ethereum dominance and Bitcoin dominance from a strength and price structure perspective. I would like to see that move back into Ethereum to really consolidate this idea that we're now consolidating at this stage, preparing for the next big move up, which is what we're still leading towards. I think in the midterm, so really looking at the next 6 to 8 weeks, I still think there's a lot of room for another leg up. But as Willy mentioned before, we're starting to get to basically to the last innings of this major first cycle, which basically means that it's going to get more volatile, right? So make sure that you're not over leveraging, make sure that you're setting limits at a healthy distance from price, because you're going to get wicks as people get liquidated trying to chase these rotations. I don't know, Willy.
Maybe Yann, you can explain why you want it to be Ethereum dominated in terms of a bullish run.
Exactly. So the reason for this, to use an analogy, so Bitcoin for us, when it comes to the general crypto ecosystem, is oxygen to everything else. So when oxygen becomes more abundant, it makes it more likely for other things to actually grow as well. So what we want to see, or the best combination for a strong alt season, is a strong Bitcoin, not an overpowering Bitcoin like we've seen over the last probably 16 to 18 months, but a consolidating Bitcoin with capital rotating into Ethereum, which basically means that Bitcoin is weakening, but it's only weakening relative to Ethereum because capital is moving in that direction. And if that happens in a consistent manner, what that basically does is that it increases the liquidity into Ethereum, which naturally creates a flywheel into all the other projects that are Ethereum based and also that are linked to DeFi or even basically L2s. And the reason for this is that a lot of the treasuries and a lot of the excess capital, the excess energy that is being built up in the ecosystem is usually dominantly done so in Ethereum. So the higher Ethereum goes, the more energy is basically accumulated for other types of activities, for speculation, for increasing treasury requirements, and propping up cash positions, which naturally then becomes a flywheel into capital allocations in the ecosystem and people basically having more money to speculate. So we want to see that persisting, because if that happens in a less persistent way, so to give you an example, if you look back at the last major cycle or the last major run that we had early November into December, we had the movement from Bitcoin capital or dominant capital into large caps and then small caps happened too quickly. And if you look historically, for a persistent, really strong altcoin run to happen, you need to store that energy into Ethereum first. So that phase in Ethereum needs to happen for long enough for that energy to really seep into the system, where people become basically sure enough that that's going to be something that doesn't just pop in and out of existence, but is there for a prolonged period of time, which allows them to start planning. And once that little bit more that phase of tranquility sets in for the investor, that allows the investor to take on more risk. So we want to see that, and that's a very good thing that we are seeing it. But I would like to see that more persistently now in Ethereum. And then once that happens, I think very quickly we're going to start moving into large caps, especially L2s and L1s, which are very, very important. And then we'll see a very small spurt into the all-time high into small caps, which is for us going to be the top signal once small caps become dominant. I don't know,
So
Willy
it's really,
or Henrik. Yeah.
I'd summarize that, and correct me if I'm wrong, is that you have a strong base in Bitcoin, but once you see this sort of these notes fire from Ethereum, large caps, mid caps, high caps, that is the signature for a proper bull run. And when you
Correct.
when it's a little bit random, it's really just a bit of noise. So when we saw a strong base of Bitcoin for a while, and then strongly into Ethereum, that was a launching pad, but it's currently it's not quite. It's sort of breaking down a little. But we do want to see that rotation because that's a very organic bull market signature.
Correct. Because at the end, for things to be
Mm.
sustainable, you want confidence. You want people to have confidence that it is going to be there for a persistent period of time. And that is super important to build a strong base for speculation, which essentially is alt season. It's basically
Correct.
relative strength of everything else versus Bitcoin. But you want Bitcoin to be strong as well, right? As you see here, even though we had massive rotation of capital into everything else but Bitcoin, our strategies were indicating that Bitcoin was so very strong, right? Which is very good. You want that to be the case, but you don't want it to be overpowering. So one of the key things that I think we have been able to identify with our frameworks, and I think also with the on-chain research and expertise that we have built up over the years, is that we can identify when something is overpowering, when there's too much oxygen to the point where you actually you kill off the plants. You don't help them grow, right? Which is really we want to find that nice balance in the ecosystem to make everything harmonious.
There's
Exactly.
a narrative within the Bitcoin world that altcoins are kind of a leech on Bitcoin, but um, I'd throw it to you as I'd ask you, do you think the sort of as the capital rotates out of Bitcoin, Ethereum, big, mid, small caps, you're starting to see these huge run-ups, right? And generally, I would say that would attract capital into the system from normies. They're like, wow, look at that. And they flow outside capital in. This is just a thesis. And then that capital, for most part, comes back into Bitcoin once it's captured. Would that be true? Have you seen any kind of measurement of that thesis to be true, or is it a leech? Or is it actually a advertising slogan that grabs capital and then generally we see it rotates back because everything comes back down against
Yeah,
Bitcoin?
I think on the long run, it is the case because most of the capital gets absorbed by Bitcoin. If you look at altcoin performance over the last 5 years, you were better off just investing in Bitcoin. Going long Bitcoin with a little bit of leverage, you would have outperformed most of the altcoins if you would have just held, right? So I think to a big extent, that is absolutely the case what you said. But at the same time, I think it's more about understanding the short to medium term relationships, right? And kind of disambiguating those from the longer term cycles and understanding that the leaching nature is actually important because we need to allow for price discovery. We need to allow for a exploration of the market to understand where value truly lies and what type of value it is that we find in Bitcoin. Because I
I
think
see.
if you look at Bitcoin today, it is absolutely becoming more and more a store of value. Look at how stable Bitcoin has been even during a major conflict, right, with Iran and Israel. It hasn't been doing a lot worse than gold or equities in a relative sense. Yes, it has maybe it's more volatile, it's smaller. So I think a lot of that attribution has to do with, us still needing to build more, I think more stability through plumbing and allowing for the right access to credit lines and these types of things for Bitcoin-based businesses. And we'll be talking about this more over the coming webinars. Because a lot of the businesses nowadays, if they have a short-term correction in their assets, they can just lend against that asset through a bank, something that Bitcoin businesses cannot do. So you have to sell the asset to prop up your book, right, or your liquidity. So I think there's kind of idiosyncratic mechanism or elements to the mechanisms that are in against us, I think, at this current moment, that kind of reflect in price in these kind of situations where
Mhm.
things are very noisy and very volatile. But I think on a long time frame, I think, there's definitely projects that are not really solving problems, but I think we're exploring what utility means, right? And I'll use an example that I think Willy gave. This is maybe like 6 or 7 years ago, Will, where we basically talked about what's the killer application of Bitcoin? And I think after 7 years, the answer to that is the killer feature of Bitcoin is Bitcoin, right? There hasn't been anything that has been more dominant or more valuable than Bitcoin itself. You can argue that stablecoins are that as well. But then my answer to that would also be, well, stablecoins are a way for you to basically value the utility mechanism of Bitcoin. So it's a extension feature of the utility of Bitcoin and not the other way around, right? So I think we need exploration, we need price discovery. And I think alt season is a way for us to be able to really push forward valid ideas. 99% of those won't work, but that 1% that does come out of alt season, I think is very valuable, right? So I think we need the leeching, right? We need people to build on ideas of other people. I think that's super important for innovation.
Yeah, I think it's really important. I think Antonopoulos was very early in that conversation where just let effectively 1,000 flowers bloom and see what survives, or you really do. We from the Bitcoin world often say everything's Bitcoin, and we know that fundamentally, but actually it's a different thing to test it in the market and see what happens. And I think there's a bifurcation right now that is very, very clear that Bitcoin is this big sink that you can store capital in, store value. Maybe that becomes money if it's stable enough some future time. But the other side of the bifurcation is most of the altcoins is about technology. They're kind of a replication of maybe startups in the tech world where you're trying something new and you're trying to blockchainify some part of the finance world, which is $5 trillion of the $110 trillion of equity. That's how it's valued in the real world, and they're shooting for this within those projects. And the failure rate is high, right? Typically, you would see a 99% failure rate and 1% survive, and so that's what we're seeing. And so I think, I was speaking to someone very, very notable in the TradFi world, and I asked him what he thought, and I was really heartened to see that he saw the same thing. Altcoins is now technology. And the world's starting to understand that, and Bitcoin is monetary asset, store of value. And it's interesting to see how the markets have sort of figured that out since, I would say 2017, when there was this idea of the flippening and Ethereum, flipping Bitcoin. Ethereum had monetary dynamics, what was it? Ultrasound money was the meme at one point. And
Exactly.
so that's definitely stopped when Solana took a bit of market share, and there's others. And I think we're seeing that that's dying, and these technology platforms are having to share market share with newer and newer technology, because each have a fitness to purpose, just like we see in the tech world. So anyway, I think it's time, 45 minutes. So let's open the floor for questions from the audience, and we can
Let
just
me
go
just
through them.
actually add a point to that, Will, because I think it's a super important thing to understand as well for our audience, that it's not just about replicating like money. To the point that you said, there's a difference in currency and money. Money is something that people truly find value in, right? There's a thing called Gresham's law that kind of explains that in a very good way. Bad money, it gets crowded up by good money, right? People will always store the thing that they find more valuable, and they will spend the thing that they see as less valuable. And at the end, I think the forking wars back in 2016, 17, 18, when you kind of had this idea of the flippening, the forking of Bitcoin to create a better Bitcoin, basically proves that one thing, that you can't copy paste the definition of value. You can do that for currency, but then you get inflation because people they just spend it. They don't want to hold it. They want to get something that they perceive as more valuable. And you can't copy network effects. And I think this is the key point. And the reason I think Bitcoin will be the winner long term, and probably has already been the winner for many years, is because of network effects. It's very, very difficult to replicate that. But yeah, to your point, I think
no second best, right?
There's no second best
right
exactly.
now. It's broken that network effect barrier, and so
exactly.
All
Super.
right.
We'll go into the questions then.
Okay. I see questions in the chat, and then there's open questions in Q&A. So All right, we've got someone who asked, oh, this one is for, I guess, Henrik. You might want to consider the possibility that Powell wants to have, oh, no, that's just a comment that Powell wants to crash the economy for Trump. So do you want to comment on that, Henrik?
I don't know. I don't think there's any central bank that want to crash the economy. I think it's a little too serious for that, and I don't think he wants to be known for that. So I honestly don't think that that's the case. I think the case is that the Fed is scared of the ghost inflation or of their own genie that came out of the bottle when they stimulated into a supply crisis back after the Corona crisis, which then created a lot of inflation. And they didn't foresee that. And that's why they're now so overly cautious on inflation, because, that's one thing that really can kill the consumers or kill them financially. That is inflation. And that's why the Fed is so cautious on that now, and too cautious. So I don't think there's anybody who wants to do that, and Trump, Paul doesn't want to kill his own reputation just to get at Trump. I don't think that's the case.
And there's also another point that people need to understand. The Fed chair and the Federal Reserve is not incentivized to jump the gun. They're getting paid to be behind the curve. There's a reason why they're always behind the curve, because they always react to something when it actually is there. And the reason they're late is that once that becomes visceral and real, it already means that it's been going on for many, many months beforehand, right? So I think that it's by design that the Fed is always late, because they always think that they can stimulate. Yeah,
I think it is by design, but I don't think it's purposely by design. I think it's something that if they really understood it, and that's where sometimes you would like to have the feeling there is a grown up back at home and at the Fed, and I think they just keep doing the same mistake over and over. I mean, they didn't think they could create inflation. They came out into Corona. They created a lot of inflation by stimulating too much. We saw it. We've seen it so many times. The same movie over and over. Being too late in hiking rates and being too slow in cutting them also. So it's the same thing over again. And this time, I just think they are overdoing it way too much. And the slowdowns that are quite visible now in the economy is something that is going to haunt them at a later stage, I think.
There's another question that just came in. I don't know. Do we want to go with we'll go with the Q&A first. So end of year target for BTC.
Yeah.
Henrik,
should I get first?
Your world.
Yeah, but I mean, guys, I think that I want to be quite honest here. I think that we're going to see a very, very big top here. There is on a long-term time frame, there is a suggestion that with just the rest of the risk assets, we're going to see a fantastic top in Bitcoin. And I think there's going to be a big move, and I'll say 150,000 around that area. I got 148 to 160 something, but that's it. And then I think it's going to be a large crash, I have to say.
Yeah. I mean, I would just say what I think about liquidity.
Yeah, how do you think liquidity, does liquidity support that 150K area?
The relationship to liquidity to actual price targets is, I haven't managed how to work that out. I would say, I was just going to say, gee, usually it's in the realm of technical art, it's just a bit of a black art and just throw a fib trace onto it. Because we don't know actually how much liquidity comes into the future. Like if you're measuring liquidity, you go, oh, it's turning now. All right, this is the top, or this might be a top. And there's more liquidity comes in. So you don't even know what the future is going to bring. And so it really is this sort of feedback loop. And if there's FOMO in the system and more liquidity just piles in, then of course the price rises. So the tail end of a bull market is very, very unstable in that you cannot predict it, right? And technical indicators like a Fibonacci trace tends to nail clusters where potentially it's a self-fulfilling prophecy where traders that are actually moving large amount of capital through the system are going, this is the resistance zone. Given I don't have one, I don't have prior market price discovery because we're in all-time highs. What do we use? Well, we're going to use, I only see really two things. One is a Fibonacci trace, which can extend into all-time highs and say this should be a resistance because of magical nature patterns and then the other one is really where people are setting up long and short positions, I can liquidate all these guys and make a lot of money and get to this target, and then it's hard to move further. So it really is a very dynamic system. And so realistically, if you're going to do anything based on fundamentals, you're not going to get the data set that you need because that data is coming in live and very fast in a full-on bull run. So I don't want to do any kind of price target. I just use fib chip traces as like the only thing we've really got.
Yeah.
Um,
Makes complete sense.
yeah.
Next question. When do you think retail will come in after hitting the lows one more time? Thank you. Also, Fed decision for no rate cuts postponed the alt season. So I'll just add one thing, and then I think this is more of a liquidity question, maybe for Willy and Henrik. But you guys always have to remember that it's when rate cuts are being done aggressively, that's usually very bad for risk on, because that means that you're already at a breaking part of the cycle, right, when something is actually broken. And people realize that the ship is actually sinking. So right now we're actually in a more of a Goldilocks zone because you have rates that are high. So the ability for funds or the incentive for funds to take on leverage and to put that into the system is higher because you can get a positive carry based on the Fed funds rate versus the lending rate that you get at the bank, right? So basically to get leverage. That's usually a very good thing. You want that to be the case. Obviously, the issue with high rates is that at some point it breaks something in usually the housing system, right? Henrik, maybe you can talk about that a little bit. But in our world, it has really postponed. From a macro perspective, the structures are the structures. Liquidity flows as it needs to. The Fed is not going to be able to influence that in the short end.
Yeah, we actually did
really,
speak of that. Sorry, I believe, but just we actually did speak of this, Jan, before. This is what kills the business cycle, as I said in the intro here, also that when we see the rates are moving up and we have yields, high yields, and it can go on for quite some time. It's like the frog sitting in hot water, and it make it increasingly hot, and then all of a sudden you'll see that it jumps out. And we haven't got to that moment just yet, but we are seeing that deterioration. So yeah. But for some time, as you say, Jan, we are in a Goldilocks zone, and it may be even better. And there is already liquidity coming into the system, also from across the world. Sorry, Willy.
Oh, yes, I was just gonna kind of build on what Jan was saying around the funds rate. This is something I didn't know coming from being more Bitcoin native. Is in global macro, you get paid. Unlike in crypto, you have to pay to go leverage long. In the TradFi world, I didn't know this, but because you can close positions, packet overnight funding, and get paid under high interest rates, all the global macro firms are getting paid to increase their leverage in the system. So suddenly you get all this flow of capital into the markets. And as the liquidity drops, as in the rates drop, actually there's a disincentive to leverage up because now it's going to cost to leverage. And so capital gets pulled out of the system, and that is actually the sign that we're approaching a bearish environment.
100%. Yeah, I think that's a very good point, actually, Willy. Very, very important. It's really, and again, it always comes down to liquidity. It's just understanding how these dynamics work and where the incentive structures are. If it's Bitcoin, obviously our bread and butter with on-chain dynamics and market structure, but also the macro side. Super important to understand. Next question, just to being mindful of the time as well. Based on the last webinar, my understanding of the recession signals seem to indicate a recession predicted sometime second half of 2025. Have I understood that correctly? Or could it extend into Q1 of 2026? Henrik?
Well, yeah, that's probably for me. Let me just share again. So the thing is that when we look at, we got all these. Let me just take this down here. When we look at the indicators here, it's not a timing indicator. It's an indicator that tells you this is things are now starting to. The Titanic has hit the iceberg. That's the best way to kind of the analog. It's not sinking immediately. It hit the iceberg, and there's no going back to that. And that is actually the moment we have passed. Then we just need to sit and wait and analyze the coincident indicators and say, how bad are they now? And we need to start seeing that coming into as I said, employment, especially. This is the labor market right now. The housing market is already there. We got it frozen solid, but we should see it also coming into the labor market. And I think it's sneaking in, slowly, and we're going to see it over the next coming months. So it's not again, we cannot say it with no precision, but normally, we see 2 to 4 quarters after the crossover here. For instance, if we saw here in August 2000, we saw the recession signal here. Sorry, we checked the November 2006, we got the recession signal, and that told that before the financial crisis that something was wrong, and we saw the sharp decline. And we're seeing something similar right now, actually. And we did see the crossover here in November 2007. That was actually, then you'll say, okay, that is the prediction of now it's close. And there are other indicators then I'll be looking for, saying, okay, when is it then we start to see that very much to do with yields. But not, I won't, really come with the date before we see the crossover here. I mean, this one can last for some time, and also there'll be, some examples here where you see it can last longer. But things are deteriorating. The ship is taking in water, and it'll only be a matter of time before we see it actually starting to flow into the to the employment. And we did see not so good retail numbers yesterday. And as I said, the housing market has been bad, and we see all the delinquencies that I talked about in credit cards, mortgage loans also, and also car loans, and that's not a good indicator for what is coming. So, as I said, I don't know what the Fed is thinking about, but as Jan said, they're kind of wired up to act too late, or at least late in the business cycle. I don't know if that answered it, but we'll have to see. So we need to follow and see when it's crossing over here, and then we should be very close to it. But for now, we still got time. I don't think the recession is here in the next few months.
Henrik, I'm looking at that cross there. That's the leading sign for recession. That crossed in February 2020, right? We really topped, depending on where you call it within Bitcoin, but we topped around. I don't have to. Let me grab the chart and have a look. I think it was definitely, there was two tops. One was Q1, and then the other one was Q2 of 2021. So it was kind of over a year later, right? And we haven't even crossed yet. So if that crosses tail end of this year, doesn't that mean that potentially we could run all the way into 2026?
So there's the chance we can do that. It's only a matter of, as you saw the deterioration we saw just before, how long can that, be sustained? How long will the consumer be able to still, spend? And we can see the numbers. Okay, it's we're not there yet. So the only thing I will say is that we need to be careful, because we know that when this crosses over, then it's the clock starts to tick. But could we head into 26? Well, it's a possibility. I think there are some signs in the stock market that we are getting to a top. I have a 60 or 800 on the S&P. And we know that the stock market normally it doesn't lead the markets, and as people think. Actually, if you go to this model here, actually does it much better, but that's for another day. But I think there are some signs that the stock market could head into a nice top in the autumn, and if that's the case, then potentially we shouldn't be far off when we see this crossover here as well. So, but let's see about it. I don't want to, we need to see it crossover before we actually can show, but it could potentially, yes, Willy. Yeah.
Okay.
There's also another follow-up question on global M2. So if that is determining when a recession is more likely. So I think you've touched upon this in the last webinar as well. Like, liquidity by itself it can change demand dynamics, right? Just because I give you an extra $10,000, let's say as an example, it doesn't mean that I just take those 10,000 and go out into the economy and just start buying products and services, right? It takes also people feeling very good, right? They need to have a feel good attitude and say, okay, I think tomorrow is going to be good as well, and the month after, I think that I have a lot of job security. I'm able to pay down my mortgage payments, and then that creates the right situation for growth and for spending, right? So this is super important. It's also, by the way, the reason that kind of just making the segue to Ethereum. You can't have an alt season and people taking risk if you don't feel like that Ethereum is going to be stably moving up and being sustainable, right? And giving that ability or that flywheel for you to actually be able to use your money and take risk.
If I could just put a few words onto this with liquidity and how it actually, because there is this with the liquidity as I call them, the people like, I think it's Raul Pal also, who thinks that, we'll just, throw money at it and it'll be all fine. The thing is, that's not how it works as I see it. So the Fed balance sheet is what we have up here. Then we have the personal interest payments on debt right here. And then we have, if you can see it here, we have the unemployment rate, and the Fed fund rate and the S&P. And this was into the financial crisis. And we saw how the Fed balance sheet actually was expanding. So that is actually liquidity coming into the market. And they did also explode the liquidity at some point when the recession was actually already going. Remember, they never forecast the recession and they never see it starting. But the thing is, what is happening down beneath is actually that the consumer is struggling because the personal interest payments are going up. And this is what causing the slowdown in the economy. And what we can actually see is, and this is where business cycle actually, leading the market, you'll actually see how the unemployment rate is then starting to bottom. And this is something you can go back and take a look at. This is actually happening into all the turns in the economy. You actually see that there's a bottoming phase in the unemployment rate, and then the Fed will start to come in and say, "Okay, we'll save today, we'll be ready." And most famously, Bernanke was standing in February 2008 and say, "If everything goes wrong and there's a recession, we'll know it. We'll start to we'll make sure to prevent it." That was 2008 February, and the recession was actually already going since December 2007. So remember, they don't see it. And they will start cutting, and they will see that the Fed fund rate is going down. And then at some point, you see the stock market actually topping out. So the thing is, liquidity, first of all, will not save the day because it's about solvency. It's about people being able to go out and make their groceries, buy groceries, buy, whatever they need. And if that stops or slows down, then you're going to see the economy going in backwards. And it doesn't help, as you just said, Jan, that if you then save a little money, you'll say, "Oh, fantastic, I'm going to spend it immediately." And if they don't, if the consumers don't, and we sit back and wait and say, "Hey, I have seen inflation. Hey, I've seen high rates. And hey, I've seen unemployment," then maybe we're just humans. We may want to spend, we may want to save that for a rainy day. And that's where the QE can become less effective. And that's what we've seen also. It becomes less and less effective. So if this is the psychology that is now dominating the consumer, which I think it started to do, then you'll see that QE will not solve it. You'll see QE may expand into the balance sheets of, or you'll see that it'll boost the financial market, but it will not drive the real economy. And I think that is the vision that we're going to see. So that was just a little on liquidity and also how. But also remember, guys, it's not the stock market that leads it. You need to look to the real economy. You need to look at the consumer, and you need to understand when the business cycle is turning, which is what we have here before you can actually see, this is the time for markets to potentially top out. So they follow business cycles, as I said. That'll be on my gravestones one day.
That's also why on-chain fundamentals are so important, because it's the only anchoring or mooring to speculation. So you understand when there's a deviation between how people use the resources, how engaged the different market participants are versus Bitcoin and actual speculation. Whenever that deviates too far, the same way that Henrik just mentioned, relating to, let's say, the stock market and the real economy, it's again that elastic band that just stretches to the point where it can't be sustainable, and it slams back. So it's super important to know when those deviations happen, and that's what we specialize in as a team. I would say probably, I wouldn't say better than everyone, but better than most for sure.
Yeah, there's a question here that talks about, to me, on how I measure liquidity. And so this is the way I look at it, is that when we're talking about liquidity, we're just looking at flows of capital. And so I'm interested in the flows of capital coming into Bitcoin, right? And it's flowing out, it hardly ever flows out, but even if it's reducing, it's not a good environment for price action moving up. So how do you measure it? Well, you measure the flows coming to the network. Bitcoin's got a UTXO framework, and so underlying that blockchain, we can measure when investors move capital between each other. Because you're sending coins between wallets. That's usually between a seller of Bitcoin to a buyer. Usually that happens through an exchange. So you're seeing an exchange and it's coming off. So you look at those flows and what price was it coming on and off at? And then you get an idea, right? We can actually, not even an idea, you can measure exactly how much money came in at the time that the flows came in and out. So you can measure basic things like cost basis and actual money being absorbed into the system. And so, but that's not actually tight, because I could send money into an exchange, and when Michael Saylor sends a whole bunch of money to Coinbase, when does that buy happen? Does it happen immediately, or is he waiting? It just sits there. So for that, to pick up on that, you really need pricing data to pick up on it. So the way in which I detect liquidity is a combination of measuring the real flows between investors that are coming into the network and using pricing signal structure to determine a tighter sort of responsiveness around it, because you should be able to pick up when that execution is happening. And so when you bring that together, then you're seeing when the capital went into the network, and also the price, the execution of it, and that's when it actually goes in, when they hit buy on button. So that's how I measure it. It's pricing signal and flows of capital, and that's all to detect the moment when that liquidity hits.
And it sounds very simple when you put it in those terms, Willy, but it takes a very long time to understand that it's actually the simple things combined together in the right way that give you the most signal. That's really the ultimate lesson that I've learned over the last 12 years. That's for sure.
Yeah, it's taken a lot of years, right? It's taken a lot of years. I mean, at it for 9 years now, and
Yeah.
so much of things were like red herrings. Yeah.
Exactly. Yeah, you literally start in a simple way. You realize that simple because you combine them and you use them in the wrong way. You think that it's actually complexity that you need to add more things, and then you get to complexity. You realize actually it's about the reduction of complexity that gives you the signal. That's the life cycle of, I guess, anything and any path to becoming an expert in the field. But yeah, maybe a follow-up question that as well. There's what altcoins are you paying more attention to? Layer one, DeFi, RWAs? I think for this question, it's going to really depend on how the liquidity cycle evolves. As we mentioned before, money moving from Bitcoin into Ethereum, looking at how stably that happens, looking at our regime shift models and the risk off signal. Is really looking at how far away we are from people feeling the pain of having losses. So that's going to be very important. And then also following our narrative structure. So I'll quickly show that for those of you that didn't see it the last time. This is basically how we track narratives. So on top of the market structure that basically tracks momentum and volatility together, so basically trend and volatility, we then overlay that with our phase analysis, which tells you where the capital is actually rotating to. And on top of that, we actually look at individual subcomponents of that liquidity based on the narrative. So this is a taxonomy that we built internally. We're more than happy to give you the composition. And we then use actually the most powerful part of our framework when it comes to altcoins, which is called the alt impulse signal. So here, this is actually what the altcoin vector is actually based on, where we actually trace the individual strength of alts within these narrative clusters. But as we speak, actually what's super interesting is that the narrative strength has been rotating between LSDs and DeFi. So that's all Ethereum based. And that's actually been the case since arguably the 1st of June. Before that, the dominant narrative was memes. And that is also very good because it means that Ethereum started through a phase of speculation, which means that there's excess capital in the system is able to prop up basically speculation when the environment is ripe for it, right? So that's basically capital just waiting to take risk as soon as they get the right signals. That's very, very important to remember as well. And we will be updating you on this through the Bitcoin vector and altcoin vectors respectively as well.
Great. I think that's a wrap. Should we wrap it up?
Yeah. Yes. Thanks a lot, everyone.
Thanks for attending. Just so everyone knows, Swissblock has got a number of publications. And the reason why we're doing this is because the team's been at it for so long, trading these markets over a decade. There's a wealth of knowledge, and we see that knowledge should get out into the world as Bitcoin is getting institutional and TradFi is coming in. And we feel like if nothing is done within our industry to represent actually how these markets work, the TradFi world will come in and try and represent that, but they will not be native. So we want to represent the space within the ethos of Bitcoin from actors within our own industry. So we thought that'd be a really good thing, something to aspire to. So this is the reason why we're putting out these publications. And they are pitched at institutions, hedge funds, family offices, people who want to come in and really understand our industry. And also, obviously, professional traders that are trading crypto, Bitcoin, that are, like full professionals. So just to let you know, and those publications are available at swissblock.net if you look for them.
Super.
Okay. All right. Thanks
Thank
for
you, guys.
coming, everyone.
Thanks, guys.